Okay, so good evening, everyone. This is our fourth meeting. So hopefully everything's going well. I think some of you are concerned about your grades, but the last time I looked over, I think the course average, everything seems to be okay. Most of you actually are at B plus to A minus range. We actually do have a few students who's really doing well. If you're not doing well or you think you're anxious about how you're doing in the class, feel free to kind of email me, express your concerns. So this week will be your last required quiz, okay? And I'm pretty sure this week's material is actually more straightforward. It's not as confusing as the previous 2 weeks. It's just the structure of the things is slightly different. And after this week's required quiz, you will have another quiz next week. It's actually a practice quiz. It's more like an assignment where you have unlimited time and you have unlimited trials. So essentially, that's actually another chance for you to make up some possible points for any of the quiz that you didn't do well. And then the final. So the final will open for 3 days, starting on Friday, and you will have 6 hours to complete it, actually. So it's actually more than enough time. I think in the past, I know the student only spent like 3-4 hours to complete the final. It will be very similar to the quiz question you see. Essentially, I kind of pick like some, 4 or 5 questions from each chapter, things like that. If you really want to know like what kind of topics are likely to be on the final, definitely try out the practice final, which is also set up as an assignment. So try it there, and then it gives you a sense of the topic that will be kind of like shown in your final exam. And you will also have 2 trials for the final exam. So essentially, that's one of the reasons why I put the final to be 30% rather than smaller, because I think pretty much everyone benefit from the 30% weight of the final exam last term. A lot of students actually get a huge improvement in the course grade after they finish the final. For this week, there were one big thing that's due, which is the investment project. So this is your last week. Make sure if you need to make any changes, just keep a record of it and continue trading if you want to follow your existing strategy. So all the trading needs to be done before Friday, the business hour. So that way you can prepare your written report. I think some of you might have already started, which is great. So for the written report, just to be clear, it has to be, focus on more of the discussion. You start with your overall strategy, what kind of strategy you're taking. If you're changing over time, make sure to actually express it in the report as well. And then you're going to pick some transaction that you think are really important and talk about it, right? And you also need to talk about why you pick those stocks, okay? Some brief discussion of the company, of how unique the stock is, that will be sufficient, okay? And then discuss how well your trading is connected to your strategy is also very important. And maybe about what kind of lessons have you learned, how can you improve in the future, things like that. All those are really good talking points, okay? So the writing is definitely more important than the trading itself, okay? I really want to see how well you understand how you can potentially, trade using the kind of like the knowledge you learned over such a short period of time, actually. Beside that, I think this week's material should be relatively easy. It focuses more on statistics. So you have, if you haven't touched statistics for a while, maybe you want to, freshen up a little bit on your stats background. So it will talk about the mean, variance, standard deviation, and then we move on to talk about how you use CAPM model to figure out the expected return. And then eventually it would kind of lead you to calculation of the overall required rate of return for the firm, which is the WACC, weighted average cost of capital. Okay, so it's definitely more about calculation, Okay, the question type should be slightly kind of shorter, but you will still see some stocks and bond coming back to you, which is the previous week material. So if I think some of you are struggling with stocks like the non-constant growth model, you will see those again, at least in a similar format. Okay, so try to kind of pay attention to those. I think some of the question actually focus on that. Okay, so what I'm gonna do now is actually quickly go over some of the challenging problems you guys have during the past week thing. Overall, I think assignment 5 appears to be pretty straightforward. It's really just talking about different capital budgeting decision rules. So you have the net present value, you have the internal rate of return, you have payback, and then you have profitability index. Okay, so all these kind of methods, especially the NPV and the IRR, can be easily resolved using calculator. I think a few of you are actually asking about how to solve it on financial calculator. You can check out the tutorial about the financial calculator. They also have abundant kind of resources on YouTube that you can figure out. But again, the main thing is knowing there are 3 key buttons on your financial calculator, which is a CF, the cash flow, the NPV, which allows you to calculate the net present value, and the IRR, which allows you to derive the internal rate of return. If you decide to use Excel to find the net present value, you really have to be kind of careful about it. Excel is okay dealing with IRR, but when they do the NPV, you cannot use the NPV function directly because the way they compute the NPV is slightly different from what we normally want to calculate. So usually I suggest a student, which I probably will do when I post this video link, I will probably also post an Excel file that I did, which show how I usually solved NPV questions on Excel. It's usually just a way to calculate the discounted value of each year, and at the very end, you sum everything up. That's a very typical way for people using Excel and how they want to do the NPV, because Excel allows you to actually have multiple series altogether, so the calculation power is very strong. Okay, so there's only one question I think I do want to kind of brought up. It's actually the assignment 5, question 5, which talks about like you have some money and the company, the government requires you to reinvest for another year until you can actually realize the return on something. I think some of you actually missed the question because you didn't see the time shift. Okay, so even though the cash flow, even though you see the cash flow at year 1, 2, 3, 4, but you cannot account for it until the following year. So essentially when you do discounting, you should actually move one period forward. Okay, so I think that's the biggest mistake sometimes you guys get. And then assignment 6, I think that's a really kind of challenging assignment. So let me just show the screen. Okay. So assignment 6 is a bit challenging because it talks about the discounted cash flow. So the key is to understand what is your incremental cash flow. So in the lecture, we talk about the sunk cost is not incremental. So you always want to remove the marketability study, the research cost or survey cost, all those not incremental that you should just remove. Okay. And incremental cash flow usually deal with the change, essentially. So if you happen to have any new product introduced, which will definitely bring you new sales, but at the same time, you will hurt the existing sales. So you have to make sure to subtract, the loss in sales for the existing product, okay? And then if you happen to have some variable cost or fixed cost, most likely the variable cost. The fixed cost is usually fixed regardless of the sale numbers. So for the variable cost, it usually depends on the number of units you sell. Okay, So if your existing sales is hurt from the new products, that means the variable cost will actually be saved somewhat. So essentially, if originally you're selling 1,000 units, now you're down to 800 units, then you don't produce the 200 units, which means you're going to save a portion of the cost, which means you're going to add it back. Okay, so that's something to keep in mind. So on the sales part, you will have a reduction, which is the loss in sales. But in the variable cost part, you're actually going to have a gain because you don't have to produce as much item. So you technically save on that portion of the variable cost. So that's something always to keep in mind. Okay. And then, for example, in the first question here, they talk about one thing, which is the after-tax salvage value. So that usually happens, let's say if you purchase an equipment at year 0, okay, and you kind of use it, and then at the very end, the equipment may worth nothing on the book, okay, but you might still be able to find a buyer to purchase it. So if that's the case, then you actually have a capital gain, okay. Whenever you have a capital gain, you have to make sure to pay the government, okay. So that's what we call the capital gain tax, okay. So the after-tax salvage value essentially is just accounting for how much money did you actually receive from the sale of a long-term equipment after taking out the tax portion. Okay. So it's important to know exactly how much is equipment at the end of the sale, at the time of sale, and it's also important to know what's a tax rate. Okay. So that's something to keep in mind. And when you have after-tax salvage value, that's a cash inflow, because imagine you're selling the product to someone else, that person will bring you a check, which is a cash inflow. Okay, so always make sure to add it back at the very end. Okay, so your operating cash flow usually equals to net income, which is after all accounting for everything, plus your depreciation, because we all talk about depreciation is not a cash charge, right? And then you're going to add any change in net working capital. So that's another concept sometimes confuse students. So net working capital technically is an asset account. So it's kind of like a saving account kind of thing. So it equals to current assets minus current liability. So when you have more current assets, you have a positive amount in net working capital. On the other hand, when you have more liability, you have a negative amount in the net working capital. If the net working capital is increased, that means you have more assets. And the only way to have the increase or to have more assets is by investing. Okay, so that's why increasing net working capital requires cash, which reduces your cash flow. So it is considered as a cash outflow. On the other hand, if you recover some of the net working capital, for example, by the end, you may shut down the operation, you collect the accounts receivable, you sell everything in the inventory, now you have some sort of recovery in the accounts receivable. When that happens, then your net working capital will decrease. So when your net working capital decrease, then your cash will increase. So the net working capital and cash always move in opposite direction. Increase in net working capital, decrease in cash. And then increase in cash, decreasing net working capital. So that's something always to keep in mind. And most likely you will have a decrease in cash at the beginning of the project, and you have an increase in cash at the very end. Okay. So going back, so operating cash flow equals to net income plus depreciation plus the change in net working capital, and then plus the after-tax salvage value. So again, the after-tax salvage value should always be added back if you want to obtain the operating cash flow for the final year. Okay, so, and then I think question 3, some of you get confused about equivalent annual cost. So equivalent annual cost is only used if you're comparing two projects that have a different lengths. Okay, so normally if the project is a standalone project, then it doesn't really matter. Okay, you only need to get the NPV. But if you're comparing two projects, that's more or less a replacement problem. Okay, then it's important to take into account how long the two items is going to last. If they don't last the same amount of years, then you have to use equivalent annual cost. Okay? So essentially that means you have one additional step after getting the NPV. So your first step is always about getting the net present value. Okay, just like any other questions, right? Whenever you want to value two projects, the important thing is you want to know what is the net present value for the two projects. Okay? But because in this case, the two projects are not mutually exclusive, are not, they are kind of replacement, right? And you're picking one and the other, they are not independent. Okay, so if the project is not independent and they have different lengths, then the next step you need to do is you're gonna set the net present value and then basically set it up like an annuity. Okay, so an annuity with a present value that's equal to the net present value of something you just calculated. And once you set it as an annuity, then you can just figure out the payment. And the payment for the annuity essentially is the equivalent annual cost. Okay, so in this case, I think if you have a question, most likely you didn't really do the NPV calculation. You simply just use the initial cost, okay, which is not correct. Because, like, for example, when you have a new computer, it does save you on operating cost, okay? Any saving in operating costs will essentially increase your net income, which increase your operating cash flow, okay? So that's why there's more to it, not just the initial cost alone, okay? So that's something to keep in mind. And I think question 4, I notice a lot of you are struggling with question 4. First of all, it is very long. You probably noticed by now, unfortunately, the discounted cash flow question tend to get very long because there's a lot of components that need to be included, okay? For instance, in this case, it needs to tell you how many units it's sold every year. And then they're talking about introducing a new dining table. Okay, and it also talks about the loss in existing sales. Okay, so that's things to keep in mind. When you do the calculation, you will say, okay, my new sales from the new dining table, that's going to be the price of the new table times the units you're able to sell every year, right? And you're going to subtract the loss in sales from the existing table, which again will be the price for the table, and then multiply by the loss in sales, which is 250 tables per year, okay? So that will get you the incremental sales change, okay? And then after the sales, you should actually move on to the variable cost, just like what I just mentioned. So for the variable cost part, you have 45% of the sales, so you will say 45% of whatever the sale volume is. That's for your new tables. And then that will be actually a subtraction because the new cost is actually cash outflow, okay? But then at the same time, because you lost in the existing table sale, which means you don't have to produce as much, so you will add back a portion of the variable cost, okay? So in this case, the variable cost for the old table is actually 40%. So you will say I have 40% of 250 tables, or 4,500, kind of each, like those costs will be added back. So you have sales minus the sale loss, then minus the cost of the new table, then plus the variable cost of the old table. And then you're going to subtract the fixed cost, okay, which is the overall fixed cost. And you're going to subtract the depreciation. And then I think you also need to subtract the tax. And then that will get you the net income. Once you have the net income, you can add back the depreciation. If you happen to have any net working capital, you're probably going to adjust for that. And then I also introduced one thing which is called the 7-year marks schedule. That's modified accelerated cost recovery system, which is another way saying depreciation system, okay? But instead of using a straight line depreciation where you have the same depreciation every year, the marks actually offer different depreciation schedule every year. So when you use the schedule, you have to make sure to follow the percentage, okay? So one thing is you have to determine, so it tells you it's a 7-year. So that means you're going to focus on the column which says 7 year, and then you're going to start from there. So that's going to tell you how much you're going to depreciate every year. But it essentially works identical, okay? All right, let's see. And another kind of twist in this question is saying about buying the new equipment. So it says the company is able to produce the new table without buying the new equipment today, okay? So that essentially means you may not have that portion as a cash flow at year 0. So at year 0, you probably will only have the inventory, okay, which is required spending of your net working capital. Okay, so that's the only cash outflow for year 0. And your equipment cost will happen in year 2. Okay, so we'll have initial cash outflow at time 0 that's corresponding to the inventory spending, which, speaking of inventory, there's also going to be an incremental change of inventory. So essentially we'll have an inventory of the new product, but at the same time you should have a saving in the inventory of the old product. Okay, so keep that in mind. That's also incremental change. But after that, at year 2, you will have an additional cash outflow, which is the cost of purchasing the new equipment. Okay, and then it also says if you purchase a new equipment today, you will have a lower market value in 5 years as opposed to, if you purchase it 2 years later. So in this case, if you decide to purchase a new equipment 2 years later, you're going to have $7.9 million at the end of 5 years, essentially. So that means your after-tax salvage value will also be different. So you have to make sure to adjust for that. So after-tax salvage value is always based on your capital gain, which depends on how much is the book value of the asset at the time of the sale. So if the book value of the asset is different at the time of sale, then the after-tax salvage value will also be different. Okay. And I think number 5 is pretty straightforward. The sensitivity, it doesn't really matter what number you come up. Your sensitivity value should actually be pretty standard. Okay, number 6 is another challenging problem. Deal with, again, it's about, you have different kind of golf clubs. So you also have kind of interaction, right? You have a new golf club, which decreases sales for one of the, which decreases sales of the expensive old club and increases sales of the cheap old clubs. So those are the interactions. So that means essentially when you do the sales amount, you will say, how much is my revenue from my new golf club? Okay. And once you have that, then you're going to subtract the sale loss from your expensive existing golf club. Okay. And you're going to add the sale gain from your cheap clubs, essentially. Okay. So that's 3 items will be giving you the incremental sales amount that's actually introduced because of the new product. Okay, so once you have the sale, which is 3 columns there, and then you move on to the variable cost. Okay, since you have 3 rows for the sale, you should also have 3 rows for the variable cost. So for the variable cost, the top row will be what is the variable cost directly associated with the new club. Okay, and the second will be the variable cost of the expensive club. Okay, since expensive club is a sale loss, so the variable cost will be a gain. Okay, so you can add it back actually. And then the last one will actually be, the variable cost for the cheap club. Okay, and in the case of cheap club, it's actually a sale gain. So if it's a sale gain, that means you have to produce more, which means it is also you're also going to add the variable cost essentially. So you have more variable costs associated with a cheap club. Okay, so these are like a 3 row each. Okay, and then once you have that, you also need to, another twist in the question is actually about the worst versus the best. Okay, so one thing to keep in mind is for your best case scenario, that means you will be able to sell the item at the higher price with more number of units. Okay, and then you're able to produce the item at the lower cost. Okay, so a lot of you just forgot about the cost always moving opposite direction. Okay, so when you see the best case scenario has a plus 10%, you basically just add 10% to everything. Okay, which doesn't work because a 10% increase only applies to the good thing, not the bad thing. okay? And the cost is not a good thing, because under the best case scenario, your ideal world is you're able to save on the cost, which means you reducing the cost is the best case scenario. So for the worst case scenario, you're just moving the opposite direction. So essentially you're selling less at the lower price, and then it costs you more to produce the item. Okay, your depreciation should stay the same. Okay, depreciation is not affected by the scenario analysis, because you calculate the depreciation amount based on how much it costs you today. Okay, since the cost today is actually reviewed already, there is no uncertainty. The scenario analysis only applies to things that's not certain. Okay, like the future cost, the future price, the future sales. All these are projected costs, projected selling price. So anytime if it's a projection, it's not certain. That's when you need to actually use the scenario analysis. You can apply the shocks, okay? But if it's certain, that's something you know today, you will not apply it, okay? So just keep that thing. That's another thing you want to make sure to remember. Okay, so again, so like in this case, you have sale loss, which the best case, will be reduced because you don't lose, you don't lose as much. And the worst case, you're going to have a lot higher number. Okay, so for the worst case, your negative always be more negative. Okay, and your positive be less positive. Okay, for the best case, your positive is always going to be more positive, and your negative is going to be less negative. Okay, all right. So again, so notice here, you will do the sales, okay, which usually include the interaction, and you also do the variable costs, which include the interaction. Okay, your depreciation stay the same, and everything else will be just like normal. Okay, all right. So, and any question about the assignment 5 and assignment 6? Okay, so if you have any question, feel free to stop me anytime using the chat feature. Okay. So for the quiz, I actually did want to go over the quiz briefly this time. I think some of you actually had some issues with the quiz question. And there's a reason for not extending the quiz time, because I already extended once to 1 hour. And besides, I really want to make sure it's actually consistent compared to the final exam. Okay. So if I extended the quiz to longer than 1 hour, then you won't be able to finish the final exam in 6 hours either, because the final exam actually has 60 questions. So essentially, if you break it down, it's the same. Okay, so that's like 6 minutes per question always. So ideally, when you do your quiz, you should be fully prepared. Okay, one way to know you're fully prepared is whenever you see a question at the end of the textbook, you should be able to come up with your answer right away. So you should be able to recognize what the topic is on. Okay, for example, in this case, you have the profitability index of an investment with the following cash flow given an 8% required return, right? So first of all, the keywords, profitability index. Okay, so that's the key concept. It's testing over here. So you right away should realize you're going to use the formula for profitability index, which is present value of the cash inflow divided by the initial cost. Okay, so once you realize which formula you need to use, the next thing is apply the formula. So you kind of like gather the present value of the future cash flow. So you have cash flow 1, cash flow 2, plus cash flow 3. Each need to be discounted by their corresponding discount factor. Okay, and once you get the present value of all those future cash inflows, you just divide it by the initial cost, which is 21,000. So that's going to get you the profitability index, which is 1.05 using this example here. All right. So for number 2, okay, it says Lucy is reviewing a project with initial cost of $38,700 and cash inflow of $9,800, $16,400, and $21,700 for year 1, 2, 3, respectively. And you want to know if the project should be accepted given the required rate of return is 9.75%. Okay, so again, so if you notice here, you really just all the answers are really associated with IRR. Okay, the only way you can determine which answer is correct is by figuring out your own IRR for these questions. Okay, so if you're trying to figure out IRR, again, you always want to use, essentially the calculator or Excel. Okay, if you use trial and error, that's going to take way too long. So the IRR essentially is a unique discount rate that sets the NPV of the project to 0. Okay, so that's one way you set it up. You will have a 0 as NPV, and then everything else will just be discounted by IRR to the corresponding power. Okay, and if you use trial and error process, it will take a bit longer, but if you use calculator, immediately will give you the answer. Once you know IRR, the next thing is you look back to the question. It says it's always about comparing it to the required rate of return. Okay, so that means now you have what is your IRR. You also need to compare it to the expected required rate of return. So in this case, we'll see the required rate of return is 0.34. So the only correct answer is only part C, okay, which is yes. Okay, notice we have a questions here. I think yes, but I need to double check. I think you will be able to see the solution. That's for sure. You know which one is incorrect. Okay, but printing it out, my guess is you should be. But if you cannot print it out, then you probably just have to copy things down. Yeah, but the solution and usually is available after quiz is closed. So you can probably just check it out, see if it's actually available. But even if you see the solution, it's probably a different set of numbers. Yeah, because in my end, I do have a print feature. So that's why I'm actually not so sure if that's the same thing. You will see. Okay. All right. So for number 3, we have it will cost $2,400 to acquire an ice cream car. The sales expected to be $1,400 a year for 3 years. After the 3 years, the car is going to be worthless. And you want to know the payback. Okay. So again, key concept payback. So you gather the payback kind of formula, which essentially is initial cost divided by the cash return. Okay, so that will be 2,400 divided by 1,400. So that's going to be 1.71. Okay. All right. So number 4, you purchased an oil well, Oil City 5 years ago at a cost of $590,000. Today, the lot has a market value of $810,000 at the time of the purchase. The company spent $46,000 to level the lot, another $3,400 to install the drains. The company now wants to build a new facility on their site. The building cost is estimated at $1,190,000. You want to know what's the initial cash flow for this project. I think that something that might really confuse you is the $46,000 and the $3,400. Okay, you notice they spend this much money to actually touch up on the lot, to level the ground, to install the drains. So you may automatically think, I want to include that in my initial cost. Okay, but one thing to keep in mind is you want to ask yourself, is this cost related to what you need to do actually? Is it related to building a new building? Okay, so if the answer is no, then it's a sunk cost. Okay, so in this case, the money they spent on leveling the lot, installing the drains a while ago are both sunk cost. Okay, so the only cost that you need to consider is how much it's going to cost you to build the building, right? Which is the 1.19 million. At the same time, you also need to consider the opportunity cost because you're building the building on the lot. If you don't use the lot for the building, you could potentially sell it. Okay, so you have to consider the opportunity cost. So by using the lot, you're giving up on the market value of the lot. So that's why you're going to add $810,000 to the initial cost as well. So it's important to realize the opportunity cost matters because no resource is free. Okay, every resource costs money. Okay, so even though you don't actually spend additional money on the resource, but because you're using it, So you cannot use it for another reason. So that's why you have to consider that. Okay, some more questions. Yes, you did buy the lot previously, but the problem is if you don't use the lot right now, you actually have the option of selling it. So it's really about trying to determine what kind of options do you have. Like you look at this lot, and then if you don't build a building, you can actually sell it because it has a market value. Okay, but if you decide to build a building on top of it, then you can no longer sell it today. So technically, you give up on the potential money you can receive on the lot. Okay, so that's why even though you purchased a lot previously, you will not consider the cost of the lot as opportunity cost. Okay, because you can't really recover the cost of the lot, but you would definitely consider the opportunity cost of the lot. Okay, because that's the direct cost of using it. Okay. And hope it's clarifying. Okay. All right, so number 5. So you have manufacturing firms, homes purchased some machinery 2 years ago for $47,000. The assets are classified as 5-year property for marks. The company is replacing this machinery today with newer machines that utilize the latest in technology. The old machines are being sold for $14,000 to a foreign firm for use in its production. What's the after-tax salvage value? So when you calculate the after-tax salvage value, the key thing is to determine what's the book value at the time of sale. So if you're following the mark, essentially you need to make sure to actually check the rate here. It says you purchased the machinery 2 years ago. So if you sell it today, you only depreciate for 2 years. Okay. So if you depreciate for 2 years, that means the 20% value is gone, 32% value is gone. So the remaining will be, you have 48% of the value. Okay. So it will be 48% of how much it costs you. Okay. So the current book value will be the residual there, which is $22,560. So now you don't know the book value. The next thing you're gonna compare the book value with, how much you're selling it. Okay. So notice here, the selling price is $14,000. The book value is $22,560. You notice you actually have a tax, a capital depreciation here. It's a capital loss. It's not a capital gain. So technically, that means you actually receive a tax credit. Okay, so that's the reason you have a negative $29,10. So if you happen to have a tax credit, you want to make sure to actually add it back to how much you can receive from the sale price. So you're selling the equipment for $14,000, but you can potentially receive a credit on tax for $29,10. So the total after-tax salvage value will be $16,910. So regardless, it's always about what is your capital change, okay? And then you apply the tax on the capital change, and then you're going to add or subtract the tax to the selling price. Okay. Let me see any questions. No. Okay, so number 6. Number 6, they're evaluating a project that will increase annual sales by $80,000, annual cost by $40,000. Project will initially require $145,000 in fixed asset that will be depreciated straight line to zero book value over the 10-year life of the project. Okay, you want to know the operating cash flow for the project. To get this, again, you're gonna get your net income first, essentially, right? So we'll start by $80,000. That's your change in sales minus the change in cost, which is $40,000. And then you're gonna multiply, basically the after-tax portion, and then you're gonna plus the depreciation tax showed. Okay, so in this case, your depreciation is $145,000 divided by 10, which means that's gonna be $14,500, and then times the tax rate. Okay, so your operating cash flow is $31,330. That's one way, right? That's one way of calculating what's your operating cash flow. You can also calculate it using net income plus depreciation. If you decide to do that, then all you're going to do is you have $80,000 minus the $40,000, then minus the depreciation, which is a $14,500, and then times the after tax, that's 0.66, and then finally you're going to add back the depreciation. So both methods should directly lead you to the same operating cash flow. So if you ever get different operating cash flow, you need to double check your calculation steps. Okay, something must be wrong because your operating cash flow should be consistent regardless of the method you're taking. All right, number 7. So number 7, you're considering 2 independent projects with the same discount rate of 11%. A costs $284,700 and has a cash flow of $7,500 and so on and so forth. Project B costs $111,000 and then have a cash flow of $50,000 from year 1 to 3. So you want to know which project is good. And the answer provide, some of the answer deal with NPV, others deal with IRR. So that means you have to compute for both NPV and IRR. Okay. So usually you want to look at the solution, the answer choice, then determine what you're supposed to be doing. So in this case, you definitely don't need to do any payback because none of the answer associated with a payback. Okay. So if you try to do the NPV, then you would just discount all the cash inflows and then subtract the initial cost from it, right? And you will do this for both A and B. Okay. In this case, it turns out project B is better because it is positive. Project A should not be taken because the NPV for project A is actually negative. Okay. You do the same thing for IRR, A and B, right? And then it turns out for A, the IRR is 8.63, which is less than the required rate of return. That's 11%. So we say if IRR is less than the required rate of return, then you're not going to take it. Okay. B, on the other hand, has IRR of 14.56, which is greater than the required rate of return. So you should go ahead and take the project. Okay. So now you have your conclusion, and then the only thing that works among all these answer choices are really just choice C, that's project B, because its IRR exceeds the discount rate. Okay. So number 8, so you have the company expect to sell 11,000 units, give or take 3%, and the variable cost per unit is $7, expected cost is $36,000, blah, blah, blah. So notice here it says you want to know what's the operating cash flow, okay, using total fixed cost of $32,000, okay. So again, you're looking for operating cash flow. You can do it either using the bottom-up method, which start with the net income, or you can use the depreciation tax shell method, okay. So usually if you don't have a lengthy question, the second method is probably easier. So in this case, you will have, okay, so they're selling 11,000 units, okay. So that's the base value. So you're going to use 11,000 units, and then you're going to times the difference between how much you're selling it for minus how much it costs you, right? So the sale price is $14. The variable cost is $7. So that's going to get you the profit margin essentially. So you know the profit margin. You're going to subtract the fixed cost. Notice here you're using the 32,000 instead of the expected fixed cost because it says at the last sentence the total fixed cost will be 32,000. So you're going to use the 32,000. Then you multiply the after-tax portion, okay, which is 1 minus the 0.34. And then at the very end, you're going to add the depreciation tax shell back. Okay, so that's going to get you the operating cash flow. Okay, so after you finish this quiz, you will realize the operating cash flow is a really big part of it. Okay, so you should expect to see operating cash flow question again in your final exam. So just definitely practice with it and then try to be very familiar with the terms, knowing what to include, what to exclude. Okay, so number 9, they're considering a new project with estimated depreciation of 31,000. Fixed cost of 36,000 and total sales of 71,620, and the variable cost per unit are estimated at 4.20. And you want to know what the accounting break-even level of production. So one thing is, if you're looking for accounting break-even, you should be very familiar with the concept. Accounting break-even essentially is telling you have a zero profit. Okay. So in this case, you're trying to identify what is the right number of units that's going to give you zero profit. So you will add together the depreciation and the fixed cost on the left-hand side, and the right-hand side will be the sales minus the variable cost, essentially. So to get the variable cost, you need to know exactly what's your desired number of units, which you're going to set it as an unknown, okay? And then you're going to just solving for the unknown. So usually these questions, the quiz question tend to be very straightforward. They always let you know what they're asking. So the only thing is whether or not you know what formula you need to use. So the last question here is they're analyzing a proposed project. They expect to sell 12,000 units and then plus minus, blah, blah, blah. So you want to do the worst case scenario, okay? So that's kind of go back related to the homework question you practice, right? You know if it's worst case scenario, you're going to decrease the selling units, you're going to decrease the selling price, you're going to increase the variable cost, you're going to increase the fixed cost, okay? But you're going to keep exactly the same depreciation, you're going to keep exactly the same tax rate, okay? So that's why after you make the adjustment, so now your selling price becomes $13 times 95% because you're going to take the 5% out. That's a decrease. And then you're going to subtract your variable cost. Your variable cost originally is to be $6, but because it's a worst case scenario, so you're going to add the 4%. Okay, so that's why you multiply 1.04. That's going to get you the profit margin under the worst case. And then you're going to multiply the 12,000, the units, times, again, take the 4%, okay? Sorry, I think the whole thing gonna be the profit margin actually. So notice here, you always, decrease the positive side and you always increase the negative side. So the next negative side you're gonna decrease is at an increase is gonna be the fixed cost. So the original fixed cost is at 35,000. The new fixed cost will be the 35,000 times 1.04 because it's gonna increase by 4%. Okay, your depreciation stay exactly the same. Just because I mentioned earlier, depreciation is calculated at the time of purchasing the equipment. So there is no uncertainty associated with depreciation. So it's exactly the same as a base value. Your tax is also the same because it's actually highly regulated. It's stated by the government. Okay, so that's also on 0.34. So that's gonna get you the worst case scenario operating cash, the net income. Sorry, not operating cash flow. Okay, any question about these quiz? Okay, so no questions. I'm just gonna use the remaining time to quickly go over this week's homework assignment, I think. So I think some of you already started. Actually, some of you already submitted. So you will notice it's actually really straightforward for your first assignment. It's essentially just calculating the returns. Okay, so calculating the average, you're calculating the standard deviation. You can do that by using your calculator. Okay, so if you have a graphing calculator, you can go to the finance, you can go to the stats. I think there's a feature say stats. You want to do two variable statistics. Okay, because it's usually two returns that you want to be doing. And then it allows you to input the list 1 and list 2, and then you can calculate everything you need to calculate over here. If, however, you're using a financial calculator, then you will be using 2 keys. Okay, so the first key is actually the 7. Okay, because if you notice on top of the 7, you should actually see the data. Okay, so what you're going to do is you're going to do second and 7. You're going to press second and 7. And that's something you're going to see. You will see X01. So that's really asking you what is the return information for your first series, right? So you should, like in this case, you have only one stock. It says the stock has a return of 14%. So the first return you're getting for this stock is going to be 14%. So you will say I have 14%. And by the way, before you do anything, you want to make sure to clear your memory. To do that, you will go second and the bottom here to clear everything. Okay, so now you have X01. I'm just going to put it as 14%. Once you finish 14%, the very important thing is making sure to press the enter. Okay, so once you press the enter, you will see the equal sign. So that means the calculator knows it's actually 14% for the first number. And you're going to go downward arrow. So if you go down, you notice it actually changed to Y. It's Y01. Because this is a 2 variable statistics. So that's why they allow you to input the information for 2 security at one time. In this case, if you only have 1 security, you're going to leave Y out. You don't have to do anything. The only thing to do is just go next again. So you go downward again. That's when you see the X02. So for X02, I'm going to put 11% negative and enter. I'm gonna go down again to X03, which is 21%. I'm gonna enter it. And then X04, which is 22%, I'm gonna enter it, okay? So once you finish that, so now you see I have X04, everything is all key in, right? The next thing I'm gonna do is actually basically I will say, okay, I have, so you're gonna go to second and 8. Okay, so got second and 8. So that lotus here, it shows it's a linear, so it's a linear relationship. And then it tells you have key in 4 returns, and it tells you what's the expected return. Okay, so yeah, so it tells you what's the expected return here, blah, 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 and so on and so forth. Okay, so this question is slightly different. It tells you some of the returns and tells you the average return. It's asking for what's the missing return. So you're basically gonna set it up so you know the average return is basically just add everything together divided by the number of returns, right? So in this case, we'll add 14% minus 11% plus 21% plus 22% plus the missing year. You can set it as X and then divide it by 5, okay? And then it's gonna equal to the average return, which is 12% times 5, that's 60. Okay, so that allows you to figure out what's your unknown return. So once you have once you have that, again, so the calculator will allow you to compute for a lot of information. So the first thing you see is actually the average. So if you press the downward arrow, that's gonna show you the standard deviation, okay? Keep in mind, this is a standard deviation you want, okay? Which is sigma x, okay? Sometimes you will see the SX, that's not what you want. The SX is the sample standard deviation, but you don't want, you always want the population standard deviation, which is sigma x. Okay, so if you happen to have two series, you will have a sigma y as well. That doesn't really matter. Okay, so again, so that really saves you some time of calculating it. All right, so things are very similar for the second questions. You're calculating the arithmetic return and geometric return, which are both introduced in the lecture, so it should be pretty straightforward. This question, I do want to point one thing out. I think in the past, I actually got this problem. So when you do part C is asking you what's the average real return. I think a lot of you have the tendency to actually choose a supposedly easy shortcut. Okay, so you probably will get the average of treasury bills and you get the average of inflation and you just kind of subtract the two and you assume it's going to get you the average real return. In most of the case, it might work, okay, but in this case, I really recommend you not to do that, okay. It might give you the wrong answer. I think it happens in the past. So what you're gonna do is you need to actually subtract the 2 for every year, okay. So you're gonna do the real return for every year, then you're gonna average the real return at the very end. Okay, so only average the real return at the very end, okay. All right, so the next questions I want to go over is actually questions 8. So for this problem here, it's looking for what's the portfolio weight that allows you to minimize the variance. A quick way to do this is by using Excel. Okay, so I highly recommend you to use Excel. If you're familiar with Excel, you remember Excel actually has a Go Seek feature. You're gonna use that. So you're gonna set one cell to be the one that you want to use the Go Seek function, okay? And that's gonna be one of the weight because you wanna have 2 assets. So it's easy to do the 2 assets portfolio. So 2 asset portfolio says if you have X as the weight for one asset, then the weight for the other asset must be 1 minus X. Okay, so that's something you can do. So if you sell one cell as something you want to use a Go Seek for, the other cell will just be 1 minus that cell. Okay, and then in another cell, you are just creating the lengthy portfolio variance formula. Okay, so that allows you to actually quickly get the weights. Okay, because they can actually compute much faster. Okay, that's assignment 7. I think assignment 7 is pretty short. So assignment 8 is slightly more complicated, and then assignment 7, because assignment 8 actually asks you to calculate weighted average cost of capital most of the time. So for question 1, one thing I do want to point out Every information is important. Okay, so the last sentence over here says the management uses subjective approach and applies adjustment factor of 0.3 of 3% to the cost of capital for the risky project. So that means, you know, you really have to make sure to add whatever you are getting. So let's say you're getting some sort of like a WACC measure. Once you have that, you're going to add the adjustment to it. Okay, so that allows you to actually get the right answer. So number 4, let's see. Okay, so for this question, I think the only thing I want to point out is making sure to include every security in. Okay, so you're looking for WACC, which is a weighted average cost of capital. So that means you're going to include the debt, you're going to include the preferred stock, you're going to include the common stock. You're looking for the market value of every security. Okay, so try to make sure to get the market value of all the security. Once you find the market value of all the security, that allows you to find the weight of each security, right? You have 3 weights, okay? It has to be the market weights, be really careful. And then the next thing you need to do is you're gonna find the cost of capital for each security. So you need to know the cost of debt, you need to know the cost of preferred, and you need to know the cost of common. So cost of common, you can use a CAPM model. Cost of preferred is actually, you know, given, it's 5%. And the cost of debt is yield to maturity. Okay, so just keep that in mind. Okay, so this question's again similar. So DDM model essentially is just the constant, known growth, non-constant growth. These models are really the DDM model. That's dividend discount model. Right? So you usually will use those dividend discount model shortcuts to find the cost of equity, which is the R. Okay, you can also use the SML method, which is security market line. So that's actually the CAPM model. So the first one is the dividend discount model. The other one is a CAPM model. So the CAPM model will give you another, you know, expected return for the security. So let's be careful on that. Okay. So number 4 actually asks you to do the non-constant growth again. Okay. So highly recommend you to actually start with a timeline. So draw a timeline, label what is what is a cash flow that you expect to have for each year. And then once you figure out the present value of your company by using the non-constant growth model, the next thing you need to do is you're going to subtract the debt, because your company is a big pie. You have a portion of it belongs to debt holder, a portion that belongs to the equity holder. So you want to make sure to chunk off the debt part that will give you the equity portion. Okay, so once you know the equity portion, the market value of equity, then you divide that by the number of shares outstanding. That's going to get you the price per share. Okay, so non-constant growth model first, get the market value of the firm. Step 2 will be take out the debt value. Step 3 will be diluting your equity, which is dividing your equity value by the number of shares outstanding. Okay, so this is another lengthy questions. I kind of just want to, remind you, making sure, to include all those components when you do the calculation for your WACC. And once you have the WACC, you're going to use your WACC to discount your cash flow, because it's actually a combination of the things you learned in the past week with the things you learn in this week. Okay, because this week is getting the discount rate. The past week is using the given discount rate to discount cash flow. So now you're learning combining the two things together and then to derive the final answer. Okay, all right. Any questions for this week? Okay, so again, just keep working on your investment project, making sure to start the report early, if you can, and make sure to turn it in before the deadline. I will be grading your case study later today or tomorrow. You should definitely see your grades for the case study tomorrow. I will also update your grade book tomorrow at the same time with your new quiz grade and assignment grade, so you can stay up to date with where you stand. And I'm also going to announce the winner of last week's kind of investment project, tomorrow. Okay, so for today, once I wrap up this meeting, which is pretty soon, I will be actually do the same thing like last time. I will kind of convert it. I will convert this to a YouTube video and post it onto YouTube. So, and then attach a link in the announcement. So that way you can actually use the link to go to the recorded meeting. And if you want to kind of go over some of the material on your own. And then I will also include the Excel file. I was talking about like the way I like to do the NPV and IRR in Excel. You can take a look at it. If you don't like it, you can just use whatever you like to use. But this is really just something I usually feel like it's very straightforward and very simple. Okay. Not necessary. You can actually leave it there if you want. You don't have to touch anything. But if you don't think you have anything that you want to trade this week, but you still want to meet the requirements, the trading requirement for this week, you can probably sell as well. Like selling is also a transaction. Okay, so that's really up to you. Okay. All right, any other questions? Okay, so if no question, that's it for today. And thank you for participating. And I, looking forward for another productive week. And email me if you have any questions, and continue participating on the Q&A. I really want to say I think the past few weeks have been really great. But one thing I did notice, a few of you still like to create a new post without checking. Okay, so make sure to check the other post before you post. Okay, some of the questions are already asked in previous posts. Okay, so if you ask a redundant question, the chances a lot of students are not going to respond. Okay, so make sure to actually checking other posts first if it's the same questions, and then you don't have to start a new post. Okay, and then that's a reason I recommend you to title, to give a good title to the post so everyone recognize what the post, what the post is about. All right, thank you, and have a good night.